Did Christmas come early? The market managed to climb for a second straight week, making us ask the question, can the PSEi finally break past the 6,200 resistance? Hi everyone, welcome to another episode of Intelligent Investing. I'm April Tan. The PSEi continued its recovery, inching up 0.4% to close at 6,022.24. Gainers once again outnumbered losers 151 to 112, although foreign investors turned cautious, selling about 3.2 billion pesos worth of shares. But overall sentiment improved thanks to two major developments. First was S&P affirming the Philippines BBB plus credit rating. This was a big confidence booster. If you remember, we got our first investment grade rating all the way back in 2013 by the Group. S&P said the Philippines' long-term growth prospects remain intact despite the corruption scandal that disrupted infrastructure spending. Second is Finance Secretary Frederick Go's forecast of a strong rebound next year. He expects economic growth to return to 5.5% as early as Q1 2026, once government spending normalizes. He also emphasized fiscal discipline, no big stimulus packages, but a targeted push to restart stalled projects.
Are you optimistic about the Philippine market, or is it just common to have this positive outlook at the end of the year?
Long term, I'm still optimistic. Short term, of course, there are a lot of challenges. But, that's one of the reasons why, remember in the past few weeks, you were talking about should you sell or should you stay invested. Diba we said naman, if you're a long-term investor, you should still stay invested precisely because of this. The market is really so cheap and everybody's already so pessimistic. I mean, this is one of the things that happens when everybody is so pessimistic. When something good comes along, the market just shoots up really quickly and you run the risk of being left behind. I'm quite optimistic, but I don't know when it will happen, which is why I always say, if you have the ability to hold on to your stocks for a long period of time, then just stay invested. The PSEi is now expected to test major resistance of between 6,070 and 6,212. And according to COL's Chief Technical Analyst Juanes Barredo, if the index fails to break above the said levels, a pullback may still be healthy as long as it forms a higher low of between 5,768 and 5,875. A breakdown below those levels means the market needs more time to consolidate. Now let's dive into what led the market's rally. Despite being some of the worst performers year to date, the following holding companies finally bounced: Ayala Corporation, Aboitiz Equity Venture, GT Capital, San Miguel, DMCI, Alliance Global, and SM. Gold miners also surged thanks to gold hitting $4,239.43 per ounce, or higher by 4.3%. Apex Mining, Felix Mining, Oceana Gold, and Lepanto were up for the week. Apart from these, there are two stocks that we want to highlight: SGP and FGEN. SGP stock popped up after declaring a second dividend of 34.74 centavos per share, payable on December 19. If it resumes quarterly payouts, the annual dividend could hit 1 peso 39 pesos per share. That's an 8.7% dividend yield at current prices. Meanwhile, FGEN's increase came after its chairman Federico Lopez said he is open to delisting FGEN if the opportunity arises, although he said that he is not in a rush. Given the stock's low valuation and small free float of 11.17% versus the PSE's minimum requirement of 10%, a delisting is possible.
Isn't delisting a bad thing?
It's bad for the market because, of course, we want more stocks to be listed in the Philippines. For a company, delisting is bad if you have capital raising requirements. But I think as far as FGEN is concerned, with, of course, right now they have 50 billion pesos in cash, they don't need to raise any more capital. So in a way, they kind of don't see the point of staying listed. And secondly, of course, the market, it's not reflecting their valuation. What could they possibly do with 50 billion pesos? And one of the things they could do is buy another company, which will generate value for them. The problem is, if you go out there and talk to any private company, you have to pay more compared to FGEN's current valuation. So one of the things we talked about is FGEN being ridiculously cheap. And how ridiculously cheap is cheap? Okay, remember we talked about them just raising 50 billion pesos from selling 60% of their gas platform. But the thing is, it's being valued by the market at only 60 billion pesos. They have 50 billion pesos, plus they still have 40% of the gas platforms. Plus, they have a big chunk of EDC plus a couple of hydro plants. So you can see just how cheap it is. So in a way, the chairman's probably thinking, why would I go out there and buy another privately held company when I could just buy my own shares? So that's probably what's going through his mind. Like, how do I maximize the value of my 50 billion pesos in cash?
So would you say that now is a good time to invest in FGEN?
If you notice, the shares of FGEN have increased significantly recently. I think the speculators have, I guess, become more confident after hearing the statement of the chairman. Earlier on, we talked about the free float requirement of 10% and FGEN's free float of 11%. This is important because by the PSE rules, if your free float falls below the 10% minimum requirement, you are forced to delist. And at 11%, it's very easy for them to trigger that delisting. So it's not just talk, it is a possibility. And the company just saying that we are open to that possibility means that they could actually do it. They could trigger the delisting of the company. Next, let's talk about banks. Their stocks have been trending lower since mid-year. A lot of investors are worried that falling interest rates will compress margin and that rising provisions mean asset quality is starting to deteriorate. But when you look closely at the latest earnings result, these concerns look overstated. Why is that? First, net interest margins are actually improving despite the BSP cutting rates by a full 100 basis points this year. If we look at the third quarter alone, the median net interest margin of listed banks rose 12 basis points versus the second quarter and 27 basis points year on year. So what's driving this? Number one, massive RRR cuts freed up liquidity. The BSP slashed the reserve requirement by 250 basis points in late 2024 and another 200 basis points in early 2025, bringing it down to just 5%. This released billions into the system, allowing banks to put more money into higher yielding assets. Number two, funding costs dropped faster than lending rates. Time deposit rates fell by about 46 basis points year on year, while lending rates dropped by only 17 basis points. That spread widened margins instead of compressing them. Lastly, growing exposure to consumer loans. Consumer loans, which carry higher yields, now make up 22.3% of loan portfolios, up from 18.2% in 2021. This makes banks less sensitive to policy rate cuts. Now, provisions did rise by about 52% this year, but this is mainly due to normalization as banks had over-reserved during the pandemic. So this year's jump to 83 basis points looks big, but only because it's coming from an unusually low base. The more important point is this: asset quality remains solid. The median non-performing loan ratio of listed banks held steady at 2.7% in the third quarter, with NPL coverage ratio also healthy at around 91%. When you put everything together, strong margins, stable asset quality, and now more attractive valuations, the recent sell-off in bank stocks looks more like an opportunity than a warning. If you're a long-term investor, the current weakness may be a chance to accumulate bank names while they are still trading at depressed levels. Besides the holiday parties and get-togethers, here's what to look out for this week. First is the US inflation and labor data, as these will influence whether the Fed cuts rates in December. A dovish Fed equals helpful for emerging markets like the Philippines. Next is the local November inflation coming this Friday. Consensus expectation is 1.7%. A soft number increases the likelihood of a December BSP rate cut, and lower interest rates would support equities. That's it for this week's market wrap. The PSEi has momentum, but breaking past 6,200 won't be easy. We'll be watching both technical levels and upcoming inflation data very closely. That's it for this week's episode. If you found this market wrap helpful, don't forget to like, subscribe, and share this video so you're first to know what's moving the market. Once again, I'm April Tan. Remember to stay sharp, stay selective, and as always, invest intelligently.